What if we told you that one of the most successful technology companies of the last decade isn't defined by its specific products, not software, not hardware, but by its ability to generate massive, durable, and predictable cash?
Yeah, like an acquisition machine that basically just prints currency.
Exactly. We are diving deep into Roper Technologies, ticker ROP.
A genuine cash flow compounding anomaly. They closed yesterday, September 27, 2025, at $499.31 share.
And their whole identity, really, it's built around how they manage the cash they produce.
Right.
We've really torn apart the sources on Roper, looking at everything from its unique management philosophy right down to the financial statements to try and determine its true value.
And our mission for you, the listener, is to analyze whether ROP's current price is trading below, within, or maybe above its estimated intrinsic value range.
And our educational model puts that range between, what was it, $510 and $575 per share.
That's right. $510 to $575. So let's unpack the model that generates this kind of stability.
Okay, part one, the foundation of the compounder. Let's start with chapter one, business analysis. The making of a cash flow compounding machine.
Yeah.
When we talk about Roper, we have to start with the fundamental structure. This isn't, your typical tech company trying to build the next big thing.
No, not at all. It is, at its heart, a highly disciplined holding company. It's what you'd call a compounder.
A compounder.
That's the key distinction, really. Their strategy is pretty straightforward on the surface. Acquire asset-light niche technology businesses.
Asset light.
Mostly, they're looking for vertical market software companies. So businesses that don't need constant, heavy capital expenditure just to keep running.
And the financial consequence of being asset light, I mean, that must be phenomenal cash generation, right?
Exactly. That's the whole point. It drives an exceptionally high conversion of earnings into free cash flow.
Which then fuels the next deal.
Precisely. It becomes a fuel for their next acquisition. And what's more, this revenue is incredibly sticky.
Sticky how?
Well, over 75% of their total revenue now comes from software. And get this, over 2/3 of the total revenue is either recurring or reoccurring.
Wow.
That makes the entire business extremely resilient, almost regardless of the economic cycle.
It's fascinating how they integrate these companies, too. It doesn't sound like the usual heavy-handed private equity approach.
No, far from it. Their operational structure is radically decentralized. Once they buy a company, the business unit keeps a high degree of autonomy.
So the existing leadership stays.
Yeah, they keep their leadership, run the day-to-day. The corporate center down in Sarasota, Florida, they focus almost exclusively on capital allocation and strategic oversight, basically finding the next high-quality target.
Okay, let's talk about the breadth of this portfolio then. They have three primary segments. Let's start with application software. Can you give us some examples? Show how niche they really are.
Sure. These are really mission-critical systems. Think Aderant, which handles law firm management, or Clinisys for essential healthcare lab administration, frontline education, managing school administrative functions. These are tools you just can't operate without.
Right. If the software goes down, the client pretty much shuts down.
You got it. Non-negotiable tools.
Then you have the second segment, network software and systems. That sounds more like the connectivity layer.
Precisely. This includes platforms that connect entire industries, like Debt Solutions, North America's largest digital freight marketplace.
Wow. Okay.
Basically running the plumbing for logistics. And then there's iPipeline, a critical platform for life insurance and financial services transactions.
Okay. And the third one, they still have a segment called technology-enabled products.
Yes, but even here, the focus is still on high-value engineered products that are integrated with software.
So still tech-focused, in a way.
Absolutely. Examples include Verathon's GlideScope laryngoscope, that's a key tool in airway management, or Neptune Technology Group, a leader in smart water meter technology, high value, high specialization.
So we have this collection of really specialized niche businesses, incredibly stable revenue. For the shareholder, what's the ultimate value proposition here?
Well, there are two sides. For customers, it's the dependability of these mission-critical solutions. Retention rates are often over 95% because the switching costs are immense.
Yeah, once you integrate something like Aderant, you're probably not ripping it out anytime soon.
Exactly. You aren't leaving. And for shareholders, the value is the proven, disciplined, and repeatable long-term model for compounding cash flow. That's the engine.
Okay, let's shift gears. Moving from the operational view, let's look at the people running the show.
Yeah.
Chapter 2, management evaluation. The architects of capital. Because in a business where capital allocation is the strategy, management is everything.
Absolutely paramount. CEO Lawrence Neil Hunn has basically continued the successful strategy laid down by his predecessor, Brian Jellison.
And what's really interesting is how this management team views downturns. All right.
Yeah, it's fascinating. They aren't passive at all. During the 2008 financial crisis, they explicitly saw that difficult environment not as a problem, but as an opportunity for value-enhancing acquisitions.
Buying when others are fearful.
Textbook. And they showed that same resilience, that same opportunistic behavior during the chaos of the pandemic more recently.
I remember reading that.
Their model just held up incredibly well, allowing them to capitalize while others were, frankly, struggling. They deployed something like $6.0 billion to acquire new businesses during the peak uncertainty of COVID-19.
So the countercyclical approach is really baked in.
It seems hard-coded into their DNA, yeah.
Now, their M&A first approach isn't just buying whatever looks good. It's driven by a specific proprietary metric, isn't it?
Yes, and this is crucial. They don't just buy anything. This is maybe the secret sauce that separates them from, say, typical private equity. They use a proprietary metric called cash return on investment, CRI.
CII.
This acts like a mandatory hurdle rate. If a potential acquisition can't generate a specific, very high return on the cash invested within a set time frame, they just walk away.
No exceptions.
Seems like it. This rigor prevents them from overpaying for lower quality assets or, chasing deals that are just fashionable at the moment. They spent about $9.95 billion on acquisitions in the 3 years up to 2025. But every single dollar apparently went through that strict CRI filter. Examples like Central Reach, Frontline Education.
Speaking of rigor, their approach to returning cash is also pretty unique. Unlike many large-cap peers, they actually use net share issuances, not buybacks.
Right, which is unusual.
But they do maintain their status as an S&P 500 dividend aristocrat. What is it, 32 consecutive years of dividend increases?
32 years, yeah. That streak definitely signals financial discipline to the market. But look closely at the actual payout ratio. It's only about 22%.
Very low.
It's deliberately low. They keep it low because they are supremely confident, it seems, that they can reinvest that excess cash via M&A at a much higher rate of return than you, the shareholder, could likely get by having the cash returned directly to you.
Okay, but let's play devil's advocate here for a second. If this is such a brilliant compounding machine, always paying a premium for quality, why is the return on invested capital, the ROIC, currently sitting at a pretty modest 5.37%? Shouldn't that be much higher if they're such great allocators?
That is an excellent question, and it really highlights the difference between accounting reality and, let's say, economic reality.
Okay.
When Roper buys a company, especially one of these high-quality vertical software businesses, they pay a premium, often a significant premium.
Right.
That premium gets logged on the balance sheet as significant goodwill and intangible assets.
So those assets inflate the denominator in the ROIC calculation, return invested capital.
Precisely. The book value of the assets is artificially high because of that acquisition premium, which mathematically suppresses the reported ROIC number.
So economically, the cash returns might be great, but the GAAP accounting makes the ratio look meh.
That's a good way to put it. The economic cash generation is exceptional, but the accounting rules make the ROIC look modest. To really understand their true profitability, you need to look at cash flow margins.
Okay, perfect transition. Let's do that. Chapter 3, financial analysis. Quantifying the compounder. Let's look at the numbers.
Right.
The 5-year growth alone is pretty staggering. Revenue grew from just over $4 billion in 2020 to over $7 billion in 2024.
Yeah, that's a 15% compound annual growth rate. Pretty impressive expansion.
And the profitability you mentioned.
Look deeper. The trailing 12-month gross margin is exceptional, nearly 69%, 68.87% to be exact.
Wow.
But the true metric of a compounder like Roper is free cash flow generation. How much actual cash are they spitting out?
And the answer is?
In 2024, Roper generated $2.3 billion in free cash flow. That translates to an FCF margin of 31% of revenue.
31%. That is truly elite.
It really is. And it shows exactly why that asset-light structure matters so much.
Okay, now for the number that probably makes traditional value investors nervous, their current ratio is very low, 0.46.
Yeah, that definitely stands out.
For most companies, that would scream massive liquidity risk. How do we square that circle? Why isn't that a huge red flag here?
You're absolutely right to flag it. On the surface, it looks alarming. But this is sort of the ultimate financial paradox of a successful SaaS model.
Bitcoin.
That low current ratio is actually a direct byproduct of their strength. If you look at the liability side of the balance sheet, you'll see a huge number for deferred revenue. It was $1.74 billion as of December 2024.
Deferred revenue. There's cash collected upfront for services not yet delivered, right?
Exactly. They've already got the cash in the bank from customers for subscriptions, often paid annually in advance. But the accounting rules count the future service obligation, the need to provide the software service over the next year, as a current liability.
Ah, so it's not like traditional debt they owe someone money back soon. It's an obligation to deliver software.
Precisely. They have the cash. The liability is delivering the service they've already been paid for. So in this specific case, a low current ratio actually signifies a very strong subscription business model, not financial distress.
That makes sense. It's counterintuitive, but it fits the model.
It really does.
Now, the market clearly recognizes this quality because it trades at a premium valuation. The trailing 12-month PE ratio is up there at 35.54.
Yeah, that's significantly higher than its own 10-year historical average, which is around 30, and also higher than peers like Amitech or ITW.
So paying a premium price. To cut through that market noise and get a more fundamental view, you used a discounted cash flow model, a DCF.
We did. We wanted to estimate the intrinsic value based on future cash flows. Our assumptions really factored in their continued compounding strategy.
What were the key assumptions?
We assumed an 8.0% free cash flow growth rate for the next 5 years. That's a blend, trying to account for both their organic growth and expected M&A contributions.
Okay, 8% growth. And the discount rate, given rates are higher now.
Good point. We applied a discount rate, the WACC, of 8.5%. This reflects the stability of their revenue, which is good, but it also acknowledges the execution risk inherent in M&A and, importantly, the higher interest rate environment we're in as of 2025.
And finally, the perpetual growth rate. What happens after year 5?
We use a standard 2.5% perpetual growth rate, reflecting long-term nominal GDP growth.
Right. And based on that whole fundamental analysis, the educational model estimated that intrinsic value range of $510 to $575 per share.
That's correct.
Okay, let's pivot now to part 2, market, ownership, and risk. Starting with chapter 4, market sentiment. Wall Street's view versus the tape.
Right.
Wall Street seems pretty ecstatic about Roper. The consensus rating is a strong buy.
Very bullish. Analysts have high conviction. The average 12-month price targets are quite high, ranging from around $633 up to $647.
Which suggests, what, over 25% potential upside from the current price?
Yeah, according to the consensus view, significant upside.
But the actual trading tape, the chart, is telling a bit of a different story in the short term.
It is. The stock price, around $499, is actually trading below both its 50-day simple moving average and its 200-day SMA.
So technically it looks weak right now.
Exactly. It indicates a current technical downtrend, or at least a pullback, despite all that fundamental enthusiasm from analysts.
Interestingly, though, there doesn't seem to be much institutional pessimism, right? Short interest is very low.
Exceptionally low, just 1.41%. So very few big players are betting against the company right now.
Okay, let's move on to chapter 5, ownership structure. Who owns Roper?
Well, this is definitely a stock dominated by professional money, institutions.
How much?
A staggering 94.4% of the shares are held by institutions. Think Vanguard, T. Rowe Price, BlackRock, the usual big names.
And it's concentrated.
Highly concentrated. The top 25 institutions control over 58% of the entire company.
Wow. Now, the flip side of that is the insider ownership. It's tiny.
Extremely low, around 0.35%.
And all the recent transactions have been sales by insiders. That usually sets off alarm bells.
It does, and it's something you always have to look at critically. Management's explanation is usually diversification and tax planning, which sounds plausible.
But for the average investor, seeing only selling from the inside, that raises a flag. Why should we just accept the tax planning rationale?
That's entirely fair skepticism, and you should always watch insider behavior closely. However, the context here is a bit unique.
How so?
About 95% of the CEO's compensation is tied directly to performance and stock awards. So for these top executives, their personal wealth becomes incredibly concentrated in Roper stock.
So selling becomes almost necessary for basic financial planning.
Arguably, yes. It's a necessary act of diversification, regardless of how bullish they might feel about the company's future. Now, if we saw this insider selling paired with, say, a sudden drop in performance or maybe a rapidly rising short interest, then the alarm bells would be deafening.
But standing alone, it's less concerning.
As it stands now, it's likely not a strong bearish signal in itself, more likely prudent personal financial management.
Okay, let's address the things that could genuinely derail this whole compounding engine. Chapter 6, Risk Assessment. Identifying potential headwinds. Slide.
Right. So internally, the strengths are pretty clear. That high recurring revenue, the amazing 31% FCF margin, the disciplined M&A machine we've discussed.
And weaknesses.
The main internal weaknesses are probably the heavy dependence on flawless M&A execution and needing a constant pipeline of good deals, plus maybe that low insider ownership, even if explainable.
But the really significant risks, the external threats, seem macroeconomic, right? Especially the cost of money.
Absolutely. The primary threat, number one with the bullet, is rising interest rates.
Explain why that's so critical for Roper specifically.
Because this company is an acquisition machine and historically uses debt to help finance its M&A strategy. When interest rates go up, their cost of capital goes up. Simple as that.
So borrowing gets more expensive.
Exactly. If Roper was borrowing at, say, 4% a few years ago and now suddenly has to borrow at 6% or 7%, that difference fundamentally changes the math for every potential acquisition.
How so? It impacts the returns.
It directly impacts the returns. A deal that might have looked nicely accretive and passed their strict CRI metric at lower rates might no longer make the cut at higher rates.
So rising rates don't just increase their interest payments on existing debt, they actually shrink the pool of acceptable future deals.
You nailed it. It shrinks the pool and reduces the potential future margin of return. It effectively slows down the compounding engine.
So the company faces a tough choice.
Yeah, they either have to lower their CRI hurdle rate, which risks compromising the quality of acquisitions they're known for, or they have to sit on more cash and do fewer deals, which means slower growth. It is arguably the single biggest threat to their long-term growth trajectory.
That's clear. And the other main external threat mentioned.
We also noted the potential impact of tariff risk. Specifically, the 2025 U.S. policy announcement about a potential baseline 10% tariff.
How exposed is Roper?
They seem heavily insulated, actually, because about 85% of their sales are domestic here in the U.S. However, there are some secondary risks, particularly for that technology-enabled products segment, which might rely on some imported components. And of course, any kind of generalized trade war could eventually weaken the economic standing of their customers, even the domestic ones. Less critical than rates, but still a factor.
Okay, let's bring it all together for the listener. Chapter 7, Conclusion.
All right. The bull case here is pretty straightforward. You have a superior, highly durable business model.
Generating massive, predictable, free cash flow.
Exactly. Which is then consistently redeployed by a proven management team through a very disciplined M&A machine, focusing on those high-margin vertical software niches. It's elegant.
And the bear case. What are the main worries?
The business is highly dependent on that M&A execution being nearly flawless continuously, and it's extremely sensitive to macroeconomic threats, especially rising interest rates, which directly threaten their ability to compound capital effectively.
And the valuation adds risk.
Yes, the existing high premium valuation means there's very little room for management error or unexpected macro shocks. You're paying for perfection or close to it.
So recapping our core finding. Our deep dive concluded the current share price, around $499.31, sits just fractionally below the low end of our estimated intrinsic value range, which was $510 to $575 per share.
Right. So investing at the current price, you could argue, is essentially a bet on management's continued ability to execute that compounding M&A strategy, even as the macroeconomic environment, particularly interest rates, becomes significantly more challenging.
There may be a slight discount due to the recent pullback, but you're still paying a premium price for a high-quality operation.
That sums it up well. It's a bet on continued excellence in a tougher environment.
Okay, so given that the M&A model really is the core driver here, the absolute engine, here's a final provocative thought for you, the listener, to mull over. What happens if the corporate team starts running out of runway? What if they simply can't find enough high-quality niche software businesses out there that meet their stringent cash return on investment metric anymore?
Yeah, that scarcity of perfect targets, that arguably even more than interest rates, might be the ultimate long-term risk to this compounder model. Where do the deals come from in 10, 15 years?
Something to think about. If you found this deep dive useful, make sure you like and subscribe to Stock Analytics AI. 4.99 Euro members get priority deep dives on tickers. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access. If you want a one-off deep dive, just drop us a super thanks.
And the important reminder, This analysis was generated by an AI system for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.